As of June 2025, my investment balance has officially doubled from 6 years ago. But wait, is this another get rich quick video or a promotion to invest in some stocks or crypto? Nope. But how? I have been investing in the same index fund consistently. It exceeded my expectations because my original formula had my investments to double every 9 years and not every 6 years. This formula is called the rule of 72. And before you start typing in the comment section, I did not inherit a family fortune and I did not sell any feet pics on the internet. What I did do was stick to a consistent, no nonsense investing strategy, kept my head down, and just kept at it. But first, what exactly is this rule of 72? Well, it's not some secret handshake to get into an exclusive club, but a few extra zeros in the account balance certainly feel like one. It's a straightforward mathematical shortcut that helps you quickly estimate how long it'll take for your investments to double, giving a consistent average annual rate of return. Now, here's the drill. You simply take the number 72 divided by your average annual return rate, and you'll get your approximate number of years for your money to double. Simple as that. For instance, if your investments are earning 8% a year, you do the math. 72 divided by 8 is 9. That means, roughly speaking, it'll take about 9 years for your hard earned money to double without making any additional contributions. In fact, even the folks at the SEC use it in their educational materials. If it's good enough for them, it's certainly good enough for us. But let's clear up some of the chatter you might hear about the rule of 72 versus the rule of 73 or even other variations out there. The classic rule of 72 remains a favorite because of its pure simplicity and ease of use in your head. However, some financial experts might argue that for rates outside the typical 6 to 10% range, the rule of 73 or even 69.3 for continuous compounding can offer slightly more precision. But honestly, unless you're crunching numbers for a NASA mission, the difference is usually negligible for practical purposes. For us, simply trying to get a solid grasp on how our money is growing over the long haul, the reliable rule of 72 is perfectly fine. Now, let's dumb this down with some examples so it doesn't sound like something solely for the academics. Imagine you're aiming for an average annual return of, say, 8%. This is a realistic long-term return for a portfolio that's heavily weighted towards stocks, like being 100% invested in a broad market index such as the S&P 500. Now, using a rule of 72, 72 divided by 8 equals 9 years. Simple, straightforward, predictable. If you start with $50,000 with no additional contributions, in about 9 years, you will be looking at $100,000. But what if we consider a more conservative approach and perhaps your portfolio has a larger allocation to bonds and leading to an average annual return of 4%? What then? Well, 72 divided by 4 gives us 18 years. So yes, your money will still double, but it'll take a bit longer. This illustrates precisely why your asset allocation, how you split your money between stocks, bonds, and other investments is so important. More aggressive means potentially faster growth, but also more volatility. A more conservative approach means a steadier but slower climb. It's about aligning your investments with your comfort level and your timeline as well as your risk tolerance. And what if you have a 401k or Roth IRA that you don't need to touch for a while you're retired? How long will it take your 401k or Roth IRA to double? Let's take a common scenario. And let's say you're 55 years old, recently retired, but you're in a comfortable position where you don't need to touch your investments just yet. Maybe you've got other income streams. You've got a solid $500,000 sitting in your 401k and your investments are averaging a respectable 7% return per year. So how long until that $500,000 becomes $1 million? Using the rule of 72, 72 divided by 7 equals approximately 10.28 years. Let's just round that down to roughly 10 years. So by the time you hit, say, 65 years old, that $500,000 could very well be sitting at $1 million. Is it going to be guaranteed that in 10 years, your investments will double? Of course not. The stock market will be volatile. So of course, you're not going to see a 7% return every single year, right? So if you're using a 4% withdrawal rate, you could make that decision whether to start taking 4% out of that $500,000 or $20,000 a year now at the age of 55, or wait another 10 years to let it grow to make it $40,000 a year by the time you're 65. This is probably one of the most common questions I get from my clients. And you can also schedule a consultation by visiting firesignature.com/consultation. And as I said earlier, my investments double in just 6 years. But before we talk about the how, let me just take you back a bit. My personal journey to financial independence, or my FIRE journey, kicked off in 2014. Now, here's the thing. I didn't actually start investing until 2016. So why the 2-year delay, you ask? Because from 2014 to 2016, my entire focus, my singular obsession was paying off a staggering $110,000 in consumer debt. Yes, you heard that figure correctly. $110,000. That's the kind of number that can keep a man up at night, staring at the ceiling, wondering where it all went wrong. And I was struggling credit card balances, car loans, personal loans, and even a loan for my TSP back from my active duty military days. But I made the sacrifices. I sold what I could, cut expenses to the bone, and lived as frugally as I could manage. And I made my own coffee before it became a trendy thing. And I did whatever it took to chip away and ultimately wipe out that mountain of debt. It wasn't glamorous, but it was absolutely essential. And once that debt was finally gone, paid in full, it was truly game on. In 2016, I immediately started contributing and maxing out my 401k when I worked in the private sector. I kept my TSP from my military service since I still had tax exempt investments from my time in the combat zones of Iraq and Afghanistan. And of course, I maxed out my Roth IRA every single year. My portfolio had a mix of index funds and a very few individual stocks. It's boring, but that's precisely how I like it. A steady ship in calm waters rather than a speedboat in a hurricane, right? And many people just want to get rich quickly, but I stay focused on the long-term trajectory. And about 70% of my portfolio is in the S&P 500. And please don't take any of what I'm about to say in any form of financial advice. You need to do your own research like I do. But anyway, the S&P 500 was and largely remains the workhorse of my portfolio. The rest of it was invested in some sector ETFs and individual stocks that I heavily researched and believed in for long-term growth. And over these past 6 years, my total return in 6 years hit an impressive 115.13%. That translates to an average annual rate of return of approximately 19%. Now, I'm not the one to brag, right? But I'm extremely pleased to be beating the S&P 500 benchmark, which is about a 17.6% average annual return for the past 6 years. Because that kind of return doesn't just happen by accident. It's a product of diligent research. Now, here's a little nuance to our rule of 72. Since my average annual return were 14% or higher, you could argue for using what some people call the rule of 74. This is a slight adjustment to the original 72 when you add 2 for every 6% increase in your return rate to potentially get a slightly more accurate estimate for a higher return. So if I were to run the numbers using my actual 19% return, 74 divided by 19 gives me roughly 3.9 years. Sounds even better, right? But here's the catch. That calculation is based on lump sum investing, where you dump a large sum of money all at once and let it grow. But in my case, I was consistently dollar cost averaging. This means that I was investing a fixed amount on a weekly basis. This strategy is fantastic for smoothing out market volatility because it buys you more shares when prices are low and fewer when they're high. But it also stretches out the doubling time a bit because not all your capital is invested from day one. So even though the theoretical math might say 3.9 years, the real world results for me was 6 years. And you know what? I'm perfectly fine with that. And I also like to mix and match the contribution schedule. I like to lump sum invest my Roth IRA on January 2nd of every year, but I like to dollar cost average my 401k, HSA, and tax brokerage account throughout the year. But here's where the real secret sauce is, and I want you to remember this. While impressive returns are certainly welcome, they were not the single most critical ingredient in my portfolio success. The real key, the foundational element, was my savings rate. And let me be absolutely clear about something. You can have the investment expertise of Warren Buffett, but if you're only putting aside $50 a month, it's going to take you a very, very long time to build substantial wealth. Your investment allocation, how much you put into stocks versus bonds, is very important. It determines your exposure to market fluctuations, but your savings rate is your undisputed superpower. That's the fuel you're consistently pouring onto the compound interest bonfire. The more you invest, especially in your earlier years, the more time your money has to grow and the less financial stress you'll carry later in life. This is why, as a FIRE investor, I'm prioritizing my savings rate and time that I have now so that my investments grow exponentially. So if there's one singular message I want you to take away from this video, it's this: your savings rate matters more than your investment returns. Period. And I know the stock market in 2025 has put some fear in some of you, but let me just tell you from my experience that I don't worry about whether the stock market is going up, down, sideways, or doing the financial equivalent of a tap dance. My approach is simple. I just keep investing. Trying to time the market is like trying to catch a greased pig, and you might get lucky once, but it's certainly not a sustainable strategy. Consistent contributions, regardless of market gyrations, are the key to success. Second, I am relentlessly focused on my savings rate, and I can't control what the S&P 500 will do next quarter or whether interest rates will tick up or down. What I can do is how much I save and invest every single month, every single week, or every 2 weeks. That's your leverage and your power. Third, I don't chase every hot stock tip or the latest trendy investment fad. I stick with what has proven to work over the long haul. I do my due diligence when it comes to individual stocks. The vast majority of my investments remain in those reliable broad market index funds. And if one of my individual stocks goes to zero, I would still be okay because I'm not putting my entire life savings into a single stock. And finally, this is perhaps the most critical point. I couldn't have achieved any of this without first getting rid of that six-figure mountain of debt. And debt is a dream killer, just plain and simple. It's an anchor that prevents you from moving forward. And once I paid it off, it felt like I could just finally breathe again. And that, without a doubt, is when the real financial growth began for me. It cleared the decks for serious investing. So if you're just starting your own journey to financial independence, or perhaps looking to recharge an existing one, know this. I've been there. I've got your back. You don't need to be a math genius. You certainly don't need to be pulling in a six-figure salary to start. You simply need to take that decisive first step, make a plan, and then stick with it consistently. And if you'd like some hands-on help getting started, just visit me at firesightchat.com/consultation, and I offer 60-minute consultations where we can sit down, virtually speaking, and build a customized financial independence roadmap together. No fluff, no judgment, just practical, actionable strategies aimed at getting you tangible results. Because if I can go from being $110,000 in debt to doubling my investments in just 6 years, then with the right approach and commitment, so can you. And this has been another beast of a video, and I hope you got a lot out of it.